Modern portfolio theory. Now, as the name itself suggests, the theory is considered to be modern. Now, what is modern? After 1929, anything is modern. Okay. So, this theory, modern portfolio theory, was created by Harry Markowitz in early 1950s. He is a very good researcher. He got even Nobel Prize. Now, what are the assumptions of portfolio theory? Now, first assumption, returns are normally distributed. In last class, we have seen that returns are not normally distributed, but here we will assume that returns are normally distributed. Second, investors are rational and risk averse. This is also not true in real life. Investors are not rational, they are irrational. Capital markets are perfect. Again, there are a lot of research paper which shows that capital markets are not perfect. Investors seek to minimize portfolio return risk at a given return. Yeah, this is something which we can work on, the assumption that, okay, for a given level of risk, investor will try to get highest return. These assumptions we can work out, but please understand it was almost 80 years back. So we should also keep all these assumptions in mind while working on modern portfolio theory. Now, modern portfolio works on diversification and correlation. Now, first of all, guys, please help me. Let's say you have two assets. Let's say Tata Motors and you have Infosys. You just invested 100 rupees. Out of 100 rupees, 40 rupees you invested in Tata Motors, 60 rupees you invested in Infosys. If you see the returns given by Tata Motors in last 10 years, let us assume Tata Motors gave 12% return, Infosys gave 25%, 24% return. Let us look at standard deviation. Standard deviation is nothing but the risk. The risk of Tata Motor is 15%. The risk of Infosys is 30%. Okay. Do anyone know what is the formula to calculate weighted average return? Can anyone help me? Or the portfolio risk, which is also known as portfolio return. You have just two assets in the portfolio. Asset A is 1, B is 2. These are the weights, 0.4 and 0.6. These are the weights. Does anyone know how to calculate the portfolio return and portfolio risk? Because FRM syllabus does not speak about these basic things, but we should know. So for those who do not know, please please write it down. Portfolio return is W1 R1 plus W2 R2, where W1 is this, W2 is this, R1 is this, R2 is this. This is sigma 1, this is sigma 2, and you have correlation also. Correlation, in the last lecture I have taught you what correlation is. Correlation is assumed to be 0.8. Now, if you want to calculate portfolio risk, that is portfolio standard deviation, then you have formula, which is nothing but under root of W1 square R1 square plus W2 square R2 square plus 2 times W1 W2 R1 R2 rho. What is rho? Rho is correlation. Now, all those who are listening to me, please write this down. These are very important formulas. I could not see these formulas in syllabus, so I thought I should just write it down. They may be there in next book, but I do not remember, so I thought I should just let you know about these formulas. Okay, got this? Now, let us look at effect of correlation on portfolio risk. If we plot returns on y-axis and standard deviation, that is risk on x-axis, and assume this to be A and this to be B. So only if there is a change in correlation, you will find risk drastically reduces when the correlation is -1 and risk does not reduce at all when there is a correlation of +1. So always remember the correlation always starts from -1 to +1. It will always remain between -1 to +1. Now, I'm sure you might not understand this diagram well. So what we will do, we will go to our Excel sheet. Let me see if I have, yes. So let me share my Excel sheet. Okay, perfect. I hope you can see my Excel sheet.
Yes.
Perfect. Okay. Now what I have done here is that I have taken two assets, asset A and B. So asset A is, let's say, Tata Motors, just to understand. And asset B is Infosys. The return of asset A is 20%, return of asset B is 10%, risk of asset A is 30%, risk of asset B is 15%. Now, I have taken 1, 2, 3, 4, 5 different weights. So, I invested complete 100% in A, 0% in B. I invested 70% in A, 30% in B, 50% in A, 50% in B, 30% in A, 70% in B, and complete 100% in B. So these are the 5 scenarios which we have taken. Now, portfolio risk and portfolio return. I have shown you 2 formulas right now about how to calculate portfolio return and how to calculate portfolio risk. Right? The W1 R1 plus W2 R2, that's how you calculate portfolio return. So look, this is W1 multiplied by R1, W2 multiplied by R2. That's how you calculate portfolio return. Portfolio risk is nothing but square root of W1 square, R1 square plus W2 square, R2 square plus 2 times W1, W2, R1, R2 and rho. The correlation rho is here. Now what I'm trying to do here is that I'm trying to draw one plot, scatter plot. Now look, this is 15%. So this is point B. Let's see if I can draw it on it. I'm not sure. So this is point B. This is point A. And this is rho is equal to -1. Now let me just change the value of rho to +1, and you will find a straight line here. Let me do it as 0, and you will find a curve out here. So always remember, what is this graph? This graph speaks about risk on x-axis and returns on y-axis. And when the correlation is -1, you will find with almost zero risk. Can you see it? 0 here. With almost zero risk, you are getting 15% return when correlation is -1. So no risk, quite well written. But when correlation is +1, what is happening here is that I am not getting any benefit of risk. It's a straight line. When correlation is 0, you're getting some benefit, wherein if you invest in this weight, you will find your risk is low than B and your return is higher than B. Right? Now, please understand or please check. 1, it's a straight line. -1, it's almost a big curve. 0, a slight bulge. I'm again going back to my PPT, and here in this PPT, we all can see with -1, I have shown you, or we have calculated this, wherein at no risk, you are getting almost 14% return when the correlation is -1. When the correlation is +1, you are not getting any benefit of risk. But when the correlation is 0, you are getting some benefit of risk. So, from all this, what I'm trying to teach you is that lower the correlation, higher is the diversification. And highest the correlation, lowest is the diversification. And with diversification, our risk reduces. We have seen it here. Okay. Any question here? Please ask.
Sir,
Yeah.
-1 correlations, it means increase the diversification.
Highest diversification. Yes, that means there is lot of diversification. What does that mean? When, look, so if the correlation is -1 between A and B, what does that means? When A is falling, B is increasing. That's what correlation of -1 tells.
Okay.
Yeah.
So one stock value is decreasing,
Yeah.
like Tata Motors, and
Yes.
Infosys is increasing. So
Yes.
it is correlated between two. So that's why my risk return is low.
Yes. So your risk is low and you're getting comfortably high return.
High return. Okay.
Yes. Is there any more questions? Perfect. Let's move ahead then. Okay. Now, Let us speak more about diversification. Diversification reduces idiosyncratic risk. What is idiosyncratic risk? It's nothing but company specific risk. Now, when you have a lot of companies, let's say 10 companies from IT, what will happen if one company failed due to fraud? Your portfolio will not get affected much. Your portfolio will just get affected by 10%. But if you invest complete all 100% of your portfolio in one company and the fraud takes place in that company, your complete 100% of your portfolio will get wiped out. So the concept, do not keep all your eggs in one basket. It came from a diversification process wherein you should not invest complete 100% in one asset or even in one asset class. So you should not invest 100% just in equity or in bonds or in commodities or in alternate investments. So you should keep some 40% in equity depending upon your risk taking ability, 30% in bonds, and so on and so forth. So, what are the benefits of diversification? It reduces the company specific risk. Importance of individual stock events diminishes. Yes. One company cannot change the outcome of my portfolio because I have many companies. And the portfolio become mostly exposed just to general market risk and no idiosyncratic risk. So only market risk remains, company specific risk will not remain. So that's one of the benefit of diversification. Now, what are the cost of diversification? Diversification is possible at low cost or at no cost also. Investors should not expect compensation for unnecessary exposure to company specific risk if it can be diversified. So, if the risk can be diversified, if you know that Infosys and TCS are very same companies. So, why do you invest complete 100% just in Infosys? You can invest 50% in Infosys and 50% in TCS, so that even if Infosys fail, your 50% amount will remain. So that's the idea behind it. So the compensation or the return which investors should receive should be determined only by the exposure to market risk and not to the company specific risk. That is what diversification speaks about. Okay, guys, we have less time, so I'm just running a bit fast. If you have any question, you can ask me in between. No issues. Okay, I have told you about diversification. Right. With diversification or with correlation, if there is negative correlation, our risk reduces. What about efficient frontier? Let us see what efficient frontier is. Okay. Now, again, on y-axis, you have returns. On x-axis, you have variance. Always remember, this is not standard deviation. This is square of standard deviation, and square of standard deviation is called variance. But again, this is a measure of risk itself. So on x-axis you have risk, on y-axis you have return. Now, what has happened is that different weights of different assets and all the assets of all around the world, I have taken it. I have put its return and its risk. So there is one asset whose risk is 12% and return is 8%. So it will come here. So I have taken all the assets and their portfolio here. And then what we did, we joined the outermost part of all the assets. And that outermost part is called efficient frontier. Now, why it is called as efficient frontier? Because the outermost part is giving you highest return for that level of risk. Now, at 8%, you have this asset also, you have this asset also, you have this asset also, this asset also, and this asset also. Which one should you choose? For 8%, you should choose an asset which gives you a highest return. So, efficient frontier is a line which takes highest return for given risk. And that's the very definition of risk averse people. Risk averse people will try to get highest return for given level of risk. And that line which we draw is called efficient frontier. And this point C, which has lowest risk, that is called global minimum variance portfolio. Why? Because its variance is the lowest one. And the corresponding return is 6%, which you are getting. This is called efficient frontier. For a given level of risk, how much maximum return you are getting, if you draw a line of return, then that is called efficient frontier. Now, point A and B, yes. Now, this point A and B will not be a part of efficient frontier. Why? Because I have another point E here and another point D here, which gives more return than what B is giving for same level of risk. So A and B will not be a part of efficient frontier. Okay. Now what I'm going to do, now I know no matter what happens, for a given level of risk, I'm going to get maximum this much return. Now, what I'm going to do, I am going to take risk-free rate. Assume it's 5% here, risk-free. The rate of government of that country. So in India, we have Indian government 10 years bond rate. And what I am going to do, I am going to draw a tangent here. I am very bad at drawing. So please try to understand this. Yeah. So the tangent is drawn from risk-free rate to the efficient frontier. And if we assume that we can borrow and lend on risk-free rate, then we can earn this return also, which is above the efficient frontier. So this line, which connects risk-free rate to your efficient frontier via tangent, is called capital market line. It is called capital market line. We will try to see that line also. Portfolio above efficient frontier are unattainable in the absence of risk-free asset. Only portfolio on efficient frontier are efficient. ये देख लिया हमने. Low risk. So risk seeker may opt for portfolio G. Yes, who wants more risk, they will go for G. Who want less risk, they will go for C, D, and so on and so forth. Now, risk-free rate, US Treasury bill is considered to be a proxy of risk-free rate for basically international transactions. Now, when you have a market portfolio and risk-free rate, you draw a line touching to a market portfolio. That line is called capital market line. Okay. This is a tangential portfolio. We have already seen that. Yes, and you can earn higher returns if you can borrow at risk-free rate. Okay, investor to a left of market portfolio. This is a market portfolio. Lend at risk-free rate. So this A is a combination of risk-free rate and your market portfolio. So maybe 30% at risk-free rate, 70% at market portfolio, and so on and so forth. But when you go beyond this point, what is happening is that you take loan of at risk-free rate and invest it in market portfolio. So maybe 110% in market portfolio and minus 10% in risk-free rate. What is minus 10%? You are taken loan of 10% from risk-free rate. So right of this M, this is a pointer. On the right of M, you borrow at risk-free rate, leveraging the investment. So again, this is an assumption. You cannot borrow at risk-free rate. Nobody will give you unless it's family. Okay. Now, I hope you know the concept, the regression line, y equal to mx plus c, or a equal to b plus cx. Now, here I want to calculate the expected return of the portfolio. So expected return is nothing but how you calculate. You take this as B. What is B? B is always y-intercept. Here, what is y-intercept? Here, risk-free rate is y-intercept. So it is risk-free rate plus this is the slope. How do you calculate slope? Slope is nothing but y upon x. How much is the y? Y is nothing but return of market minus risk-free rate. So return of market minus risk-free rate. How much is the x? X is standard deviation of market. You're getting my point? Now, so A, what is X? X stands for standard deviation of portfolio. Now, this is an equation to calculate expected return of the portfolio. Now, what are these terms? These are risk-free rate. This is return of market. This is risk-free rate. This is standard deviation of market. And this is standard deviation of the portfolio. And that's what the equation is. This equation came from simple regression line, and the formula is A equal to B plus Cx. or some people write as y equal to mx plus c, where c is constant, which is nothing but y-intercept. And that's how you can calculate the return of portfolio. Okay. Now, if you see this is a slope. Just a sec, guys. Okay. I want to erase this. Okay, perfect. Yeah. So this expected return of market minus risk-free rate upon standard deviation of market, this is nothing but Sharpe ratio. Now, what is this Sharpe ratio? Sharpe ratio tells us how much excess return you are generating, right? By taking 1 unit of market risk. So, for 1 unit of market risk, how much excess return you are generating, that is given by Sharpe ratio. And Sharpe ratio is nothing but slope of capital market line, is as simple as that. The slope of capital market line is Sharpe ratio. Sharpe ratio measures the risk adjusted return. Basically, for 1 unit of risk, how much excess return you are generating. We will see the formula in future. Yes. I hope you have heard about CAPM, that is capital asset pricing model. Capital asset pricing model is again derived from capital market line itself. It has developed by William Sharpe in 1960. Basically, the formula is return of portfolio is nothing but risk-free rate plus beta multiplied by return of market minus risk-free rate. This is a formula, well-known formula to calculate return of the portfolio. Now, always there are some assumptions of CAPM. First is information is freely available to everyone. That is not the case. Frictionless market, that means there is no tax, no commission, no transaction cost, and so on and so forth. Investment can be done fractional, so I can purchase 0.0001 shares of Tata Motors. There is perfect competitions and market price are perfect. Again, this is an assumption. Expected return and variance are known. Deviation from normalities such as skewness and kurtosis are ignored. That means basically returns are normally distributed. This is the assumption. You can borrow and lend at risk-free rate. That is not the case. But again, that is an assumption. Investor has same forecast of expected return, variance, and covariance. So everyone will come up with same expected returns, same variances, and same covariances. Again, that is also an assumption. Okay. You must not solely rely on result of CAPM. You must use other models like Gordon growth model to calculate the cost of equity or to calculate the expected return. And like any other model, CAPM has limited and should be used with caution. We already seen beta and systemic risk. Okay. So systemic risk or systematic risk is nothing but market risk. The risk which belongs to complete market is also called as systematic risk. Unsystematic risk is company specific risk. Now, beta measures market risk or systematic risk. So basically, beta tells us the relationship of any stock, let's say Infosys, with the market. What is Indian market? Indian market is Nifty. So beta of 2, what does that signify? It signifies that if Nifty increases by 10%, my Infosys will increase by 10% multiplied by 2, that is 20%. So beta shows us the relationship of your asset with the market. Now, does this happens every time? No, it happens just in long run. So it represent the sensitivity of asset to the market rate. So if Nifty decreases by 10%, there are chances that Infosys will decrease by 20% if the beta of Infosys is 2. So low beta stock, high beta stocks, this is nothing but sensitivity of the market. Now, how do you calculate beta? Uh, and that's not in your syllabus to calculate it in Excel. I would have shown you, but don't worry. Simple. The formula is covariance of your stock with the market upon variance of the market. Variance is nothing but square of standard deviation. It can also be written as rho. What is rho? Rho is nothing but correlation multiplied by standard deviation of a asset divided by standard deviation of a market. Now, this is the formula to calculate beta. We can easily, with the help of formula, calculate covariance. On Excel, we can easily, the formula, calculate variance of the market, and then that's how we can calculate the beta. Now, covariance measures the relationship between asset return and market return, and variance represents the variability of the market return. So variance is nothing but square of standard deviation. So that's how you calculate beta, and beta can go up to 10, 12 also. So it's not just like correlation will always be from -1 to +1. That is not the case with beta. Okay, beta greater than 1 means more market risk and considered as cyclical. So higher the beta, you call it as a cyclical stock. Lower the beta, you call it as non-cyclical stocks. Cyclical has securities beta greater than 1. Luxury goods, we have seen this. Okay. So cyclical stocks, they perform better during expansion period. Why? Because their beta is greater than 1. So if Nifty increases by 10%, they will increase by 20% because beta is 2. But when economic depression or downturn is going on, when market goes down by 10%, here your Infosys stock will also go down by 20% because beta is 2. So defensive stock does better in economic recession where beta is low, let's say 0.3, 0.4 or something like that. So whose beta is low, those stocks are called defensive stock, low beta stocks. These are called defensive, and high beta stocks, these are called cyclical stocks. This is a simple example. We are doing the first example here. Now, basically, we are supposed to calculate beta. Now, in order to calculate beta, you should remember the formula of the beta. There are two formulas. One is covariance upon variance, or rho multiplied by standard deviation of an asset upon standard deviation of the market. So let's see what is given. If asset A standard deviation is given, correlation is given, rho is given, and the standard deviation of market is given. So just use this formula, put out the values 0.8, 0.3, and 0.2. The beta came out to be 1.2. Because it is more than 1, it is cyclical in nature. You can calculate it with the help of covariance. So covariance is given and you already know the variance. So 0.20% you need to do square of it. Simple. So I'm not spending time on this. Very simple. So if you want, you can do it. Okay. Now, again, estimating beta through regression. Now, regression analysis, we are doing regression analysis. But here we are not just taking returns. We are taking excess return. What does excess return means? Return of your asset minus risk free. So that is excess return. What is this? Is assets excess return, and here you have market excess return, means return of market minus risk free, and the slope of that line is beta. Please understand, beta is nothing but if you plot excess return of your asset. So this is your asset, Infosys. So Infosys excess return is 3%, wherein Nifty's excess return is also 3%. So you plot it here. Next, I will take this. So Infosys excess return is 5%, wherein Nifty's excess return came out to be 8%. So you plot all these points and then you try to draw one line which fits all this. How you draw this line? So that the distance, the square distance between these points should be minimum. So we call it as sum of square error, SSE. Now, when you do this, the slope which you get, that slope is called beta. Now, you are not supposed to calculate it. You just need to understand how you can calculate beta. So, if excess return of asset is plotted on y-axis and excess return of market is plotted on x-axis, and you draw a regression line, the slope of that regression line is a beta. Is as simple as that. Yeah, least square regression. Perfect. If you have any questions, please ask. Otherwise, I am moving. Oh, my time is running very fast. Anyway, now we have come till beta. Now let us calculate CAPM. When you have returns on y-axis and beta on x-axis, now beta is market risk. I have told you this, which is also called as systematic risk. So rather than taking complete risk, which we have taken on capital market line, you remember capital market line? There we have not taken beta, but there we have taken standard deviation. Now, when rather than taking complete standard deviation, we are just taking beta, that line is called security market line and not capital market line. Now, for different returns, we have different betas. Higher the beta, higher is the return when you draw that line from risk-free rate. Again, you know the equation of slope or equation of line, y equal to mx plus c, where c is nothing but y-intercept. Now, here again, let us understand this. Our y-intercept is risk-free rate. We know this. Plus, beta is there itself. Beta will be as it is. Now, only we are worried about m. What is m? M is nothing but the slope of this. How do you calculate slope? Y upon x is the slope. How much is the y? Y is nothing but return of market minus risk free. So for m, in the numerator, I am writing return of market minus risk-free. What is X in the denominator? Beta. So for market portfolio, beta is always 1. And here the beta is 0. So it will be 1 minus 0, which is effectively return of market minus risk-free. So overall expected return, I will write it here. So expected return of your portfolio is nothing but A, is nothing but risk-free rate plus M. We have calculated M here, that is return of market minus risk-free rate into beta. And this is nothing but a formula for calculation of CAPM, that is capital asset pricing model. So if you know beta, if you know risk-free rate, and if you know return of market, you can calculate expected return of portfolio. Any question here? Perfect. Let's move ahead then. Yeah, this I have already taught you. How to calculate M. Yeah. Now, this expected return can be viewed as minimum required return or a hurdle rate for a given level of systematic risk or market risk. Now, if a portfolio manager can earn more than the expected return, that is good. And if he earns less than expected return, that is bad. So he will have to choose stocks which will give more expected return. So he will have to choose for undervalued stock. And he should invest in undervalued so that in the long run, it will become fairly valued and you will get more return than expected return. Now, other type of stock is called overvalued. And you should not invest in overvalued stocks, or rather you should sell overvalued stocks. So the expertise of portfolio manager depends on how well he choose undervalued stock or how good he beat expected return. So we get alpha. What is alpha? Alpha is the return of portfolio minus expected return of portfolio. So your expected return is 10% and your portfolio manager gave 12%. That excess 2% is called alpha, which is also called as Jensen's alpha. So we have seen alpha now. We have seen beta also. Let's move ahead. Okay, expected return. You are supposed to calculate expected return of the stocks using capital asset pricing model. If you remember the formula, expected return is nothing but risk-free rate plus beta multiplied by return of market minus risk-free rate. This return of market minus risk-free rate is called market risk premium. So let's say what they have given you. Following expected market risk premium. This is given 5%. Both return of market minus risk-free rate, market risk premium is given as 5%. Risk-free rate is given as 4%. And beta is given as 1.5. So 5 into 1.5, that is 7.5 plus 4 should be 11.5. That's the answer. Nothing to worry about. It's as simple as that. Now, what you are going to do, you are going to start from risk-free rate, which is 4%. Now, How much will be the return of market if market risk premium is 5%? That is return of market minus risk free is 5%, and you know risk free is 4%. So return of market will be 9%. Basically, you have a risk free rate at 4% and you have return of market at 9%. You draw a line. Exactly. That line is called security market line. The slope of this line will be beta, which will be equal to 1.5. Now, any security which plot below security market line, these are overvalued because for this much market risk, you are getting only this much return. And any security are undervalued because for this much market risk, you are getting this much return, which is way more than the return given by security market line. So everything above security market line will be undervalued, and anything which is below security market line will be overvalued. Okay. Now, we are studying portfolio management. When we study portfolio management, we need to find out whether the portfolio manager is giving justice to the fees which we are paying. And we should not focus only on raw returns, but analyze the risk taken to generate those returns. And how we try to judge that? These are some traditional performance measures. The first one is Sharpe ratio. We have seen this. Excess return per unit risk of the market. Jensen's performance index, trainers performance, these two things. So trainers speaks about excess return upon excess return risk. Okay, I will show you the formula itself, don't worry. So the Sharpe ratio, again, a person who created CAPM model also created Sharpe ratio, which is nothing but return of portfolio minus risk-free rate upon standard deviation. So per unit of standard deviation, how much excess return you are generating, that is given by Sharpe performance index or Sharpe ratio. Now, it tells us how much excess return you are generating per unit of risk taken. Now, second one is trainer. Trainer ratio is same as Sharpe ratio, only the difference is rather than take a total risk, you just take market risk, or which is also called as systematic risk, which is also called as beta. So, per unit market risk, how much excess return you are generating, that is given by trainer ratio or trainer performance index. There is nothing else in this. Excess return, yes, there is definitely excess return. Per unit of excess risk, that is important. And which risk? Market risk. In Sharpe ratio, you have total risk here, standard deviation, which is nothing but total risk. Now, third is Jensen's performance. I told you about Jensen's alpha. So it's nothing but performance index is taken as alpha. Now, what does Jensen's alpha says? This is nothing but CAPM. How much your portfolio is earning beyond CAPM, that is given by Jensen's alpha, which is nothing but expected return of portfolio minus return calculated by using CAPM. It's as simple as that. If Jensen's alpha is positive, that implies portfolio is undervalued. And if Jensen's alpha is negative, that means portfolio is overvalued. Now, Jensen's alpha is most suitable for comparing portfolio that have same level of systematic risk or market risk. So if there are two assets whose betas are almost same, let's say 1.2 and 1.2, then if you calculate Jensen's alpha, you find out that how good the manager is working in order to create some good returns and try to find out undervalued securities. Example, yes. If you remember the formula, it's just plug and play. So I will say return of portfolio minus risk-free upon standard deviation. This is for Sharpe ratio. For trainer ratio, return of portfolio minus risk-free upon beta. And alpha is return of portfolio minus CAPM. Okay. For a portfolio of 10 stocks, I'm not worried about how many stocks are there. Portfolio's expected return of portfolio is given as 14%. Standard deviation of portfolio is given as 25%. Beta of portfolio is given as 1.1. Expected return of market is given as 12.5. Standard deviation of market is given. Standard deviation of market is given as 20.5. Free rate is given as 2.6. So for calculating Sharpe ratio, you have return of portfolio is 14% minus 2.6% upon 25%. And you will get the answer. Similarly, just plug and play. There is nothing to worry about here. And you get the answer. Do it at home. If not, I'm not sure. I need to speak with others. If you want, we can solve it, but that will unnecessarily waste our time. But it's up to you. If you want, from next class, we will solve this. Now, there are some alternative tracking approaches, which are also called as modern approaches for evaluating the portfolio. Tracking error, information ratio, and Sortino ratio. Now, let's see one by one. Now, tracking error speaks about standard deviation, but with relation with benchmark. This B is benchmark. Now, many a times, if I am working with Infosys, I will keep Nifty IT as benchmark. Or if I'm working with SBI, I try to keep Bank Nifty as benchmark. So you calculate tracking error, which is nothing but standard deviation with respect to your returns of benchmark. And that is called tracking error. It tells you how far away are your portfolio returns than your benchmark. So if your return of portfolio and benchmark are same, your tracking error will be 0. Even if your returns are really good than benchmark, let's say return are 20 and your benchmark is always 10, then also tracking error will be higher, because it doesn't matter whether your portfolio returns are positive or negative as compared to benchmark. They are away from the benchmark. That's what tracking error finds out. And N is number of securities. or number of times we have calculated it. So that's what tracking error. Tracking error close to zero is good. Tracking error away from zero tells you that your return of portfolios are away from the benchmark. Next is information ratio, widely used nowadays, very widely used. It is nothing but active risk upon tracking error. So we have seen Sharp ratio, trainers ratio, and this is information ratio. So in denominator, in Sharp ratio, we have total risk. In trainer ratio, we have market risk. And in information, you have tracking error, which is also called as active risk. And you will find here you have active return in information in the numerator. For Sharp and trainer, you have return of portfolio minus risk free. Instead of risk free, in information ratio, we are taking return of benchmark. That's it. So excess return of benchmark over tracking error. What is tracking error? We have seen the tracking error in the earlier slide. So excess return upon per unit of excess risk is information ratio. Higher the information ratio, better is the manager. The last thing is Sortino ratio. Now, Sortino ratio is similar to Sharp ratio. Only the thing is, rather than taking complete deviation, we just take downside deviation. What does that means? We only take standard deviation of all the values wherein you have negative returns and not positive returns. So that is called downside deviation. Why? Because if you are getting excess return, why should it be a risk? So only deviation or only standard deviation with negative returns is downside deviation, and return of portfolio minus minimum return, or how much is the minimum acceptable return. I want minimum 5% return. That is minimum acceptable return which you want. Now, always remember Sortino ratio is difficult to calculate but easy to understand. So unless you are a hedge fund manager, you will not go for Sortino ratio, because hedge fund manager works with all not normal investments, normal distribution investment rather. So they try to invest in options, they try to invest in levered products, they try to invest in derivative products, which are all non-normal, and all these ratios are calculated with the assumption keeping in mind that returns are normally distributed. So Sortino ratio is generally used by hedge fund managers to calculate non-normal returns. I think let's take an example. Here is a formula for information ratio. Here is a formula for Sortino ratio. Active portfolio management is trying to beat FTSE 100. Now this is your benchmark. Financial Times Stock Exchange. It's a London stock exchange. The expected return of active portfolio FTSE 100 are, so this is return of portfolio and this is return of benchmark. While tracking error is directly given. Tracking error is 9%. The minimum expected return R mean is given as 4% and downside deviation is given. Everything is given. So here put 15% minus 12% upon tracking error is 9%. 15%, 12% and 9%, you get 0.33 as information ratio. While Sortino ratio is return of portfolio, that is 15%. Minimum return is 4%, 15 minus 4, 9. Upon downside deviation is given as 7%. So Sortino ratio is 1.57. That's how you calculate Sortino ratio and information ratio. Perfect. I am done with both of the slides. If you have any questions, I am here for next 1 minute. Otherwise, I will be dropping off.
Sir,
Yeah,
Somaji,
yeah.
when the SARF measures is less than the market risk, মানে,
When the Sharpe ratio, right?
হুম, হুম,
Okay, when the Sharpe ratio is less than the market.
হুম,
Okay, what's the question?
at the what scenario that is the SARF ratio is lesser than the market risk?
No, no. If you see the Sharpe ratio, the formula for Sharpe ratio, return of portfolio minus risk-free upon standard deviation of portfolio, right?
হুম,
Now, Sharpe ratio speaks about total risk.
total risk.
Total risk comprises of market risk, credit risk, liquidity risk, and all other risk, right?
হুম,
So, Sharpe ratio is a ratio of returns. So, in the numerator, you will have returns. So, Sharpe ratio came out to be, let's say, 1.57%. Now, what does Sharpe ratio tells? That if your standard deviation is 1%,
হুম,
then my return is 1.5%. So for taking a total risk of 1%, I am generating a return of 1.5%. That is given by Sharpe ratio.
okay,
So higher the ratio, better it is. It speaks about total risk and not just market risk. So if you want to take market risk, take trainer's ratio.
okay.
You got, have I answered your
So
question?
Sharp ratio is total market risk.
No, no, total risk, not only
Total
market
risk.
risk.
Total risk. Market
Market,
risk, credit risk,
credit risk,
liquidity, all.
everything. And Sharpe ratio is measured by, sorry, the risk of Sharpe ratio is measured by standard deviation.
Standard deviation.
Yeah. So that's total risk and not just market risk in Sharpe ratio.
Okay.
Got my point?
Yes, sir.
Yeah. Any more question?